Alright guys, so as we discussed on the last slide, it's obviously really crucial that we do some research and align you with the right players, and that's all part of the business plan, the game plan, and I've started to already write here A, so it's obviously the section that you saw previously. Now I've called it apprenticeship stroke training types. So in relation to the jobs that I showed or vocations that I showed on the previous slide, where you've got the mechanic, doctor, lawyer, whatever it is, if you think about it, as you're entering those fields, clearly the typical research you're going to do beforehand, before you get into execution phases, you're going to look for the best apprenticeships out there, the best mechanic shops, the best doctors, lawyers, whatever it is, to see if you can go and work underneath some of these guys, or at least follow the same training rigor or process that they did. So that's why I call it apprenticeship stroke training type. So let's get on with looking at the major players and see what they each offer, and for our business plan decide which one is best for us. Now I've written 7 years here and 5 here, and I'll come back to that. That's essentially the amount of time that I've spent at these firms, including doing the full training program at both of these institutions. So I think I'm pretty well placed to put together this business plan for us. Now, if we start by looking at what do each of these firms do? Well, before investment banks, obviously there are commercial banks, and that's where your wages go into, deposits, savings. They're actually split out from investment banks because obviously governments, regulators don't want people's savings to get mixed up in investment banking activity, so they've ring-fenced those two apart. Nevertheless, traditionally what would happen is, like I say, you'd save in a deposit-taking institution, the place where you put your card machine and pull your wages out, etc., etc. Now, they would give you a savings rate, let's just call it 1%, it could be anything, and they may lend that money out. So they're borrowing that money from you essentially when you get your wages paid into there. They might lend the money out at 6%, 7% to corporations or individuals. The spread between that is 5%, so they're making 5%. Now, with the profits they're generating there, obviously some of that will be returned to shareholders, some will be reinvested, but a lot of that will go into their investment banking arms, where they will try and generate even more returns out of that surplus capital. It's just the original deposit taking, obviously they're not allowed to put in there, but in terms of retained profits, etc., they're free to do as they wish. So to generate surplus returns out of that surplus cash that they're making out of the commercial arm, and also obviously they'll be having profits in their investment banks as well that they want to then re-employ to earn returns out of. They'll have specific functions. Now, we're just going to focus on trading clearly because that's what we're interested in, but just as a side note, they have many functions. So in particular, they'll be helping big companies manage their balance sheet. So it could be going out into the capital markets, into the public space, and raising money through bond issuance. Could be other corporate finance activities like mergers and acquisitions, and so on and so forth. Many different parts, but one large part is market making, which is a specific type of trading where huge profits are generated, and an area I'm very familiar with, having worked at one of the largest investment banks in the world for 7 years. Now, typically what market makers are doing is they're like wholesalers. So they fulfill a function to provide liquidity to the whole market. Without these guys, there would be no foreign exchange market. Why is that? Well, if you think of other wholesalers in the market, I think Costco, Walmart, just put WM there, and then there's Tesco, Sainsbury's, etc. in the UK. Now, these guys are wholesalers, guys. Everyone else here that you see is the other side. That's why these guys are called the sell side, and everyone else here is essentially the buy side. Selling, buying, right? And that's no different to wholesalers that are selling goods and products. They provide liquidity, they provide the market for buyers to come and buy stuff from. So if Costco, Walmart, Tesco didn't exist, or obviously in reality you've got smaller shops as well, but let's imagine it was only wholesalers, because ultimately even those small shops themselves are buying from these wholesalers. Guys, there'll be no market. Doesn't matter if you're willing to buy a pack of chocolate or whatever it is, you've got the money to buy. If no one's willing to sell it to you or create a marketplace, it doesn't exist. So that's what market makers do. And in a future slide and module, we will go into a lot of detail about market making and how they make money and where they get involved in the market, because that's going to help you with your trading. But for now, we're only interested in terms of, is that type of trading going to help our business being us? Well, clearly it's not, because we're not really interested in market making. So what I'm actually going to do is, as we go through these, I'm going to give them a grading out of 100, and we can decide which one of these is best for us to get our apprenticeship stroke training from, which one is best to mimic. So we already know we're not really interested in the wholesale side of the business, even though it generates huge profits. Now there is some risk taking. In fact, there's a lot of risk taking, but it's linked typically to the market making. So what I mean by that is there'll be a lot of client flow. So by client flow, I mean these guys, hedge funds, real money. Like I said, they're on the buy side. They're coming to the wholesalers. They're coming in via salespeople. So typical investment bank will have traders who don't necessarily execute directly with these guys. They're executing in an interbank market with themselves at other investment banks. Then you'll have salespeople and you'll have research. So what salespeople do is they'll go out in the marketplace to find customers like big hedge funds, big real money pension funds, to come and bring business into the investment bank, and they'll bring that business to traders. So what traders get to see is this customer flow, and they'll be using that to their advantage. In return for that, they're obviously providing liquidity. So that's client order flow. Now clearly we're not going to ever be able to see that. Now, having been on the inside and worked across all these functions, I've seen the client order flow, but because I'm on the outside now and I've evolved essentially through the list, and now I'm a home retail trader like you, I don't have access to that. So for us, it's not going to be of any benefit. We're not going to get access to that, so we can rule that out. But yeah, so coming back to this, the risk taking that they're doing is typically related to this. So out of, we've got 3 sections here, approximately just over 30% each. Would you agree that there's no sell side activity that we're really going to be learning that much from in terms of a training program? Market making, not really, even though I'm going to show you what it's about. We don't necessarily want to learn to market make, because we're not going to have these clients coming to us. And then the risk taking, to some extent, we're going to be doing. That's quite similar, i.e. we want to buy or sell and make profit. So out of 30, I would say approximately 10% is relevant to us. They're using fundamental research heavily in different ways. Again, I'm going to come back to that in a future module as to how they do that. But that's very similar to how we may want to use fundamental research. So for us, that's a tick. We already established client order flow. We're not really going to be a part of, because we won't see this. Algorithmic programs, which are automated programs. Again, I'm going to show you later exactly how they're using this and how they make money from that. But for us, it's not really relevant. So out of these 3, it's only fundamental research. So maybe 10% out of the 30. And then here, would you agree that in terms of the markets they're looking at, probably a lot of this is not relevant to us. Now, why do I say that? What are illiquid markets? They're going to be things like corporate bonds, structured instruments, where there isn't a big marketplace for it. We're obviously interested in marketplace like stocks, commodities, and to a larger extent foreign exchange. We already know the trillions of dollars number cited, so clearly it's a very liquid market. It's easy for us to go and buy Eurodollar. As and when we want it, we can buy it. Illiquid simply means if I want to buy a structured instrument or a corporate bond, for example, I want to buy the risk in the debt of a company, it's not going to be easy for me, just click a button and buy it. The liquidity is going to be low, and investment banks are dealing a lot in that type of stuff. So a lot of this is not relevant to us. So again, I would say maybe half of it, if that. So let's call it 15%. Now we add these up: 10, 20, 35. Let me just get a different color. So yeah, 35% out of 100 is relevant to us. So let's move on to the next one. Now, real money pension funds, what are they doing, guys? Essentially, the reason why pension funds and hedge funds are actually very similar in the sense that they're managing large pools of capital of other people and other institutions, but typically this is fully invested. So by fully invested, what do I mean? I mean that you can't take leverage risk. So basically, if you want to buy stock, for example, you're going to fully buy the stock. You're fully invested. And the reason for that is, if you think about it, these guys are taking people's pensions. They're restricted by covenants within the contracts that they enter into with these pension funds, but also by the regulators as to how much risk they can take. Because if you think about it, you've got a pension fund, your parents have got a pension fund. Clearly, you don't want companies going and investing that stuff in risky assets. So there'll be huge restrictions on what they can do. So they are risk taking, but it's restricted. And that's why I would say, out of, say, the 30% allocation to this box as part of our business plan, let's give them 15%. That's relevant to us. Fundamental research, same as the investment bank, is going to be very similar to what we're doing, although very in depth. And then order flow, they'll probably be looking at similar types to order flow to what we look at. The only thing is the fundamental research is going to be very long term, because if you think about it again, pension assets, guys, you've got a pension invested somewhere, that return needs to be paid to you maybe at some point in the future, a long way away. These guys need to generate returns over long periods of time, so they're more interested in longer term horizons. So let's give that, just knock it a little bit out of the full 30 allocation, 25%. And then similar to this, they're going to be looking at highly liquid and semi-liquid markets. So similar to investment bank, some of it isn't going to be relevant to what we're doing. So I give it 15%. So here you've got 30 and 25, 55. So it kind of makes sense that they're a little bit more relevant to what we're doing, simply because they don't have the market making function and so on and so forth. Now, hedge funds, similar to pension funds, as I said, but can take leverage risk, can go short, etc., etc. Now, on the buy side, similar to the real money funds, they'll be going to the investment banks to buy. They'll be doing full risk taking. So actually, the reality is, guys, they're pretty much doing exactly the function we're looking to do, right? We're looking to take full risk, speculative risk. We can go short, we can go long. We don't have any restrictions. So there's a perfect match for us in terms of hedge funds, potentially. Fundamental research, we're doing, they're doing. Client order flow, similar to the investment bank client order flow. These guys are getting that information directly from the investment banks. So as I said here, we're not really interested in that. So that can be ruled out. They're getting that because that client order flow is coming from them. They're exchanging it back and forward with each other. We're not going to have access to that because we don't go directly to the investment bank. Algorithmic programs, same as these guys. We're probably not going to be doing much of that stuff, so that can be ruled out in terms of automation. Although it's possible, but at this stage we're not looking to do that. It's a very advanced stage. So out of the three, 1 out of 3 is 10%, right? And then finally, same as the other guys, they're doing both liquid and illiquid stuff. So some of it's not going to be relevant to us. So 15, so that's 40, again 55, which kind of makes sense. Very similar to pension funds, but just with less restrictions. So kind of makes sense that they'll be getting the same type of grading. So just about 50% relevant to what we're trying to do. Now, finally, I want to look at, now just bear in mind I have left off central banks. Central banks, I know, have a big part to play in the market, but they're doing that more for like economic policy intervention, not necessarily outright risk taking so much. So I've ruled those out straight away. We're just going to waste time putting that into our business plan, but I will discuss their functions later on when we actually look at them from a trading perspective. Excuse me. Now, proprietary trading firms are really interesting. Now, proprietary trading firms are very similar in nature to hedge funds. What do I mean by that? Well, they essentially fulfill the same function as hedge funds, but without the clients and without the highly liquid flow. So let's just give them a grading to highlight all of that. So first, exactly what do proprietary trading firms do? Well, like I said, they're taking similar types of risk to hedge funds. It's unrestricted and it's outright risk taking. Now, they don't have clients. So what do they have? Well, they're typically started out by one or two people who have a bunch of capital and they just want to grow that capital. So what they'll do is they'll start a firm, little office, they'll have various trading stations around and they'll just hire traders. Now, those traders will be very similar to you and I. Either they'll be from investment banks or pension funds, or they'll typically just be new traders that are looking to make it in the industry, and they'll train them up. So very, very similar to the home retail trader, except that rather than working from home, you're just working in an office. So if we look at the first section, we've just established that they're pretty much doing exactly what we want them to be doing. So that's pure risk taking. They're trading electronically, which obviously we would want to be doing going forward, and then they've got this added benefit of futures. Now, that's a tool which is in part B as part of our research, but as I've already hinted at, that's going to give us major transparency over the market. So that's a big tick for us. They've got order flow, not the type that we don't have access to, but the type that we do have access to, exchange traded order flow. So that's a big tick in the box. It's basically the raw data that I spoke about in the previous slide. They do a bit of algorithmic trading, which we're not really interested at this stage because it's very advanced, although potentially in the future. So for that reason, we'll just give it 25% here, not the full 30% allocation. And then the great thing about this versus going to a hedge fund and learning is that obviously here is very closely aligned to what we're trying to achieve, trading from home. You won't be able to trade illiquid instruments from home. So, you know, even though I've been through the training programs and learned all about illiquid instruments, me teaching you all of that, or us aligning ourselves with institutions that teach that, isn't going to be of great benefit. Whereas look at proprietary trading firms, guys. No liquid instruments, only liquid markets. Huge tick in the box. Full 30% allocation. Now, what I haven't noted here is, and I want to give a bonus point to this section too, is because there's no clients, guys. Look, here you've got clients, here you've got clients, here you've got clients, here there's no clients. Why is that relevant for our business plan? Well, we're looking to get an apprenticeship somewhere relevant to what we ultimately want to achieve, right? We want to get the right type of training. Any of these types of training are going to involve client management, dealing with clients, dealing with pension funds, dealing with high net worth individuals, dealing with these types of customers. That's really going to take us away from what we're ultimately trying to achieve, which is making returns using outright risk. These guys don't have that. So for that, I would suggest, you know, worth a little 10% bonus. If you disagree with me, do your own business plan. You're more than welcome to come out with your own percentages. Like I said, this is my own business plan that I'm trying to do for both of us based on my experience, but you're more than welcome to give this a go and adjust the percentages as you please. But if we add those up, 30, 60, 85, 95, guys, almost 100%. The only difference between this institutional type trading and what we're trying to achieve is the fact they walk into an office and work every day around other traders. Will typically be doing it from home. So I think, you know, kind of getting very close to the answer now. Just before I conclude the business plan and align us with the correct firm, which I think you can already see which one it is, Let's look at the retail education sector, guys, and let's grade that, because that's going to be really interesting for us, and it's relevant because that seems to be what is available to most retail traders. I'm obviously fortunate that I've had access to institutional training here and worked for many years successfully here, and subsequently I then decided to go into proprietary trading, had a full training program there as well, and had many successful years doing proprietary trading, and now I've evolved into obviously trading at home alone. However, majority of people don't go through that route. They will have had retail education. So if we just grade that, right, and I'm not going to be biased, I'm going to be totally objective and look at the facts, which is that a retail educator will give you, and by the retail educator I mean someone who hasn't been through a full training program or traded from an institutional perspective successfully, they're going to show you pure risk taking. So that's a tick in the box. So I'm going to give them points for that. But what they're lacking is this futures element. They've got the electronic element, but they're not looking at the raw order flow or platforms that offer that. So we can only give them half, right? 15 out of 30. I'm going to come back to technical analysis in a sec, this section. Then at the bottom, obviously for this, you've got highly liquid markets, stocks and futures, and the retail education sector, which is as per left, is stocks, but it doesn't have futures, guys. So this element is missing. It's got highly liquid markets, but it doesn't have, again, as we saw up here, markets that allow us to obtain information beyond the charts. So again, it can only give that 15%, right? Obviously that's the ultimate aim, but you won't get that out of a retail education course. And then finally, guys, look at this. Retail education, you're getting technical analysis, simple candlestick charts. Do you see that anywhere here? Now, so far in the last slide in this, we're all aligned. Our business plan tells us we need to be following institutional type training. Where here do you see any technical analysis, simple candlestick charts? Guys, in 16 years working in institutions, I've never seen technical analysis being used in my life. So, you know, you've got to make a call now in your own business plan, whether that's something based on the evidence I'm giving you, you want to continue with, or whether you want to do what evidence shows is the correct way, which is not that. So not only is that 0%, but I'm actually going to give this minus 30. Why is that? In fact, I think I'm being generous there. The reason being is not only does this stuff stop you learning the right things, but it actually takes you in the opposite direction. So you want to be going in this direction. This stuff, guys, is taking you away from that. So it's a double whammy. So someone who's not doing that has already got a head start over you. So that deserves minus 30. So overall, the score is 0. If you add those up, 15, 15 and minus 30 is 0. So clearly, guys, our business plan has a winner for the best apprenticeship or training program we're going to try and mimic. That's going to maximize our chances of success, to be pure risk-taking traders with the best information, and obviously give us the best chance of success for what we want to achieve, right? So let's conclude our business plan. So we want to be aligning ourselves with prop firms. So just before we move on to the next slide, let's summarize what we figured out in our business plan here. And I'm sorry because I know my head covers this, but it does say prop firms there. But essentially, what our business plan is telling us is similar to what we said right at the start. So we said that we want to go out there, we want to gain an apprenticeship and the type of training in the correct institution. So if that was a mechanic, we want to find the right type for what we want to achieve, and also the right institution or the right mechanic shop in that example. So let's say we've just found the best mechanic shop. Would you agree, guys, if you were rating, this is the point of me saying all of this, if you were rating, say you had 5 mechanic shops to choose from, and one came out with 95 over 100. These are okay, and then you got 35 over here. And then one of the mechanic shops, when you were doing your research, gave you 0 for whatever reason. They were doing none of the stuff you wanted to. They had a poor track record. It was clear that your chances of success there were virtually 0. Would you go and make an application there to work there? No, of course not. So why are people doing it? Why are people continuously doing this type of stuff? And I don't say this to rub it in. I get it. There's a lack of proper education out there. The reason I'm saying it is because I want to reiterate why it's so important that we just did this business plan. Can you see what it's enabled us to do? It's enabled us to rule out a significant part of things that we're just going to be wasting our time looking at in order for our business, us, to succeed. And it's just important that I say this last thing, and that is that, look, yes, I'm bashing retail education. Now, at the end of the day, I haven't mentioned any individual names, so I've got nothing against anyone in particular. It's just in general. I don't think anyone can disagree with me that that particular type of education isn't really going to get you anywhere. And if I didn't say that, then I'd be doing you a disservice and being dishonest to you. So I'm merely doing a business plan where I'm saying, look, get the right type of training. If you don't want to do that with G7FX because you don't think it's a good fit, that's fine, guys. But do your business plan. Hopefully you reach the same conclusion, and for heaven's sake, get the right type of training, which for you is going to be proprietary trading type style of training. So if it's not us, go and find someone who has this experience. Obviously myself, I've not only got experience here, I've also got experience training here. I can combine the two plus all my years of successful trading experience and come out with something amalgamated. But you know, if you think there's something out there, great, just make sure it's in the right box and you do your business plan first. All right, guys, see you on the next slide.